What if I told you there's a way to refinance your VA loan with almost no paperwork and in half the time of a regular purchase? I'm Jason Wood, and after nearly 20 years specializing in the VA loan, I'm here to reveal to you the VA's best kept secret, the VA Interest Rate Reduction Refinance Loan. The VA Interest Rate Refinance Loan, or as we call it in the industry, the VA IRRRL, sometimes known as the streamlined refinance. Why? Because it actually is super streamlined. It's designed to be quick, easy, and save you money. Today I'm going to cover what the benefits are for your VA IRRRL, what the requirements are going to be, what the process is like, and what are the most common questions. But make sure to stay all the way to the end for a special offer I have for you after watching this video. Let's start with what makes the VA IRRRL such a powerful tool in today's market. The VA IRRRL offers several advantages. Minimal paperwork compared to most traditional transactions. There's no appraisal required. There's no income verification required. There's no asset verification requirement. There's no new certificate of eligibility required. There's a reduced funding fee compared to the VA loan on the purchase side. There's no money required out of pocket. You can roll in the closing costs into the loan, and it can close in half the time of a regular refinance. Think of it this way. The VA is basically saying, hey, we already approved you once at a payment up here. So it's kind of a no-brainer if you're going to drop your payment here that you could still make that payment, especially after proving to us you've been easily making these other payments at the higher level. It's kind of like you're a VIP and you're getting the VIP treatment through this new refinance program. Let me give you a quick example. So my client actually refinanced his loan from a 4% down to a 3.25%. This saved him about $220 a month. And the great part is we did the whole thing in 17 days. He had no money out of pocket. He didn't even need to leave his house for any part of the transaction. The documents he had to send were only a couple documents because we had pretty much everything we needed already. Let's talk about the VA IRRRL requirements. Now, to qualify for this loan, there are a couple basic requirements that you're going to need to know. To be eligible for the VA IRRRL, you have to already have an existing VA loan because this is a VA to VA loan refinance. You need to be able to certify that you previously occupied this home as your primary residence. That's right, previously. So you could have already moved out of this home recently or many years ago, and the market just happened to move in such a fashion that now you can refinance and drop that rate. You don't currently have to live there anymore as long as you did. But if you're still living there, of course, it works for you if you're still living there. The new loan must have a net tangible benefit. Primarily a lower interest rate and lower monthly payment. You must have made at least 6 payments on the current VA loan, and it has to be at least 210 days from your first payment until we can close on the VA interest rate refinance loan. Your payment history also needs to be good. You can't have any more than one 30-day late in order to be approved for the VA IRRRL. So essentially, if you've had 6 on-time payments and your interest rate is reducing, you're approved. Now that net tangible benefit that I mentioned, basically we have to be able to reduce your interest rate by 0.5%. That's a requirement by the VA. That is the net tangible benefit when we're going from a fixed rate to a fixed rate mortgage. So you're starting out at a 6% VA loan and you're refinancing down to a 5% VA loan. That's a fixed to a fixed. You're moving at least 0.5% lower in rate or more. That works as your net tangible benefit. Now, if you're moving from an adjustable loan to a fixed rate loan, that also counts as net tangible benefit because you're going to something that is more secure, leaving the adjustable and going to the fixed. Albeit, it's pretty rare to see a VA adjustable loan, especially in today's market, but you never know, they might resurface and become popular again. Unlike a cash out refinance, you cannot take any equity out of the home doing the VA IRRRL transaction. It is strictly for reducing the interest rate. So the only cash component of it that can be used is to roll in the closing costs so that you're not coming out of pocket with any money at the closing. Let's talk about the process, the step-by-step process for getting your VA IRRRL. The first thing you need to do is gather your documentation. Now, if you're going back through the same lender that helped you with your original purchase, your documentation list is going to be even shorter because they probably have all these items already. But if you're going with a new lender, here are the items that you're going to need to start the VA IRRRL refinance. You're going to need a current mortgage statement, a copy of your DD 214. You're also going to need a copy of your home insurance declarations page. So if you went online and opened up your policy, there's a page called the declarations page, and that shows what the annual amount of your insurance premium is. You're going to need that as well. A copy of your driver's license or some form of ID. And then lastly, you're going to need a copy of the note. This can be a particularly hard document to find if you're not familiar with your loan documents from when you closed previously. So the note is a document from your closing package that is basically the agreement between you and the bank that says, I'm borrowing X dollars, I plan to repay it at a certain rate of interest over 30 years. It's usually a 2-page document, either on letter size or legal size paperwork, and it's wedged in there in that big stack of paperwork you got from when you closed. This can sometimes be an easier transaction if you go back through your same lender because they likely have a copy of that note. However, if you have a copy of your closing documents from your last loan, it's definitely in there, and it usually says note in big capital letters on the top of it. And the final step is closing on your IRRRL refinance. So the whole transaction usually takes typically 2 to 3 weeks. When you get to the end of the refinance transaction, most lenders are going to set you up with a mobile notary that can even come meet you at your house or your place of work to sign your final loan documents with you. These have to be wet ink signatures in front of a notary. One important note to know about VA IRRRL transactions is you're going to be receiving a lot of mailers, solicitations via email, and social media presence of people advertising the VA IRRRL. Oftentimes they're going to be advertising things like unheard of low interest rates or skip 2 months payments. So it's important that you do some due diligence or reach out to your lender to help you walk through and determine if that offer is legitimate or not. What I found in helping people out with this is oftentimes that too good to be true interest rate is in fact too good to be true. They're offering a teaser interest rate that they can't even offer, and they hoodwink you into sending way more documentation than the loan program requires. Some of them even require a $500 deposit on a credit card and won't guarantee your interest rate till it's through underwriting. So you got to be careful on some of the offers that you receive. The other thing you're going to notice a lot in many of the VA IRRRL advertisements and solicitations is skipping 2 months payments. You are not guaranteed to skip 2 months payments. This is a timing piece, a timing component based on when you made your most recent payment and when the loan is going to close. It can be structured in a way that you end up skipping 2 payments, but you're not guaranteed to skip 2 payments. So here's how it works. On a normal transaction, let's say we close on a refinance in the month of March. The month of April, there'll be no mortgage payment due. So that's the 1 month skip. So in every either purchase or refinance transaction, that's how it works. So in this example, your first payment would be due May 1st. Well, in order to make it set up so that you skip 2 months, what we would do is make sure that we close your loan in the month of March, but we have you hold the payment that you would have initially sent March 1 to your mortgage company. We're gonna have you hold on to it. Don't spend it, just hang on to it. When we fund the loan in the month of March, that will count for the March payment. You still skip April, and then the first payment is due in May. That's how you make it 2 months. And the reason that we advise people, if that's what you want to do, because there is a little bit of risk, right? If something gets delayed, you go on vacation and you're not able to sign paperwork or whatever, if things get delayed a little bit, we want you to still have that money in hand so that if we have to make a payment before the end of the month, we can, so you don't get a recent late on your mortgage and also tank your credit score. So it's important that you hang on to it. So it's all timing. It's not a built-in 2 month skip. You have to time it right, and it's not a guarantee that you're going to be able to pull it off, especially if you have your mortgage on auto pay and you forget to turn it off while you're doing the transaction. Let's talk about closing costs, because closing costs actually do exist. Just if you remember on your purchase, there were closing costs. Now, a lot of times, some people will forget some of the transactional details of their home purchase. But in all home purchase and all home refinance transactions, closing costs exist. So closing costs are the fees from the third-party entities that make the transaction come together. So an easy one, like on a purchase, is the appraisal. Appraisers don't work for the lenders. They're an independent person who runs a business, and they appraise homes as their business. They charge a fee for doing their service. Likewise, the government, the county, the local county you're in, charges a fee to record your deed, whether it's on a purchase or on a refinance, recording that new deed of trust. They have a fee for their service. And there's other companies too, the title company, your home insurance company, and so forth. So all these companies have a fee for their service, whether it's a purchase transaction or a refinance transaction. And those summed up are what are termed as your closing costs. Now, on your VA IRRRL transaction, one of the beautiful things about it is you don't have to pay your closing costs out of pocket like many people may have done on their purchase. Now, some people may not have paid any closing costs on their purchase because they were able to negotiate it in such a way that the seller paid them for you. But that doesn't mean they didn't exist. Someone else just paid them. Now when we do the VA IRRRL refinance, we can roll those closing costs into the loan, so you're not coming out of pocket with any money. But just know the closing costs don't vanish. They still exist. They would just get financed into the loan. So what are the main closing costs? It's a really good question. The main closing cost you're going to see is the VA funding fee. The VA funding fee on a VA IRRRL is 0.5%. So if you have a Purple Heart or you have a VA disability rating, then this is waived. So if you did have that when you purchased your home, it was waived for you. And then again, on this refinance and future VA transactions, it would also be waived. But that's one way to negate that. The other thing you're going to be seeing on there are the title company fees and also setting up a new impound account for your tax and insurance reserves. That might sound a little interesting, so let me explain that for you. So what the impound account is it's the reserve account to pay your property taxes and your insurance when they're due. So every month as you've been plugging along, making your mortgage payment, part of that breakdown on your statement is for escrow, which is your taxes and your insurance. So every month when you make that mortgage payment, they're taking that escrow allotment and they're just kind of sticking it off to the side, like in a savings account. And it sits there until it's time to pay the property taxes or pay the insurance. And when that due date comes, the lender automatically sends out the payment to the county for the taxes or to the insurance company when the premiums due. So that happens automatically. Well, when we do a refinance transaction, basically we're shutting off the existing impound account that you've had and been building on. We're shutting it off and we're paying it off. So now through the transaction, we need to build a new one. So when your new refinance starts, you're not behind on taxes and insurance and get yourself into hot water. So we have to build that new reserve account. That's going to be one of the larger line items in the refinance costs. What I'll share with you is when your loan closes, a couple weeks after closing, you will get a refund check in the mail. And that refund check is going to be for what was existing in your escrow account when we paid off your loan, because we're going to pay off that account as well. So if there was $1,500 in that escrow account when we closed that loan and then replaced it with the new one with the VA IRRRL, then a couple weeks after closing, you're going to end up with a check in your mailbox for that $1,500. So it does sometimes almost wash, not exactly, but it can make it pretty close to where you could actually take that check from the refund and apply it as a principal reduction on your first mortgage statement and really negate that expense if that's what you chose to do. You could also do the same thing if you skipped a mortgage payment and apply that as well. That's the way to really negate all the costs on doing the refinance, is to plug in those saved dollars as a principal reduction. So here's how to determine if a VA IRRRL makes sense for you. And the VA actually has rules for this, which is why if you remember earlier I mentioned, like, be careful on some of those offers you get where the interest rate sounds too good to be true, then they don't stick to their word and they make you jump through all these hoops to get it. Oftentimes what they're doing is they're just picking the lowest interest rate on their rate sheet, which might have lots of points, discount points, 2 points, 3 points, whatever, which when they do this math, which is required by the VA, they're not going to be allowed to offer you that anyways because the cost for the rate is too high and the math doesn't work. So that's why they're trying to get you in the door and wait till the underwriter makes their decision on what rate you can have, which is not how it works, but they're just saying that to you because they're trying to suck you in. So when we do your refinance, the VA's requirement is that your monthly payment savings, so we reduced the rate, which reduced your payment, right? So if we're saving you $100 or $200 or $500 a month, that monthly amount times 36, so 3 years worth, takes care of the closing costs and covers the cost to do the loan. Now, the one thing that we exclude from that math calculation is setting up that new reserve account for the taxes and insurance. That's excluded from that math calculation. But that's what has to be determined. It has to be recouped within a 36-month period. So if you do that math on your own, can these closing costs be recouped in 36 months or less because of the dollar amount that you're saving, then it makes good sense. And also you have to plan on staying in that loan for that length of time. So one thing that I advise people is if you're looking at the math and the payment savings says you're going to break even on this loan after 23 months, well, then you need to plan on staying in that loan for at least 24 months. So at least you get some benefit before you refinance again, because a lot of people will refinance right now, then rates drop in 8 or 9 months and they refinance again. And so now they're never realizing the true savings from the first one. So you have to do that math to make sure that you're not throwing good money after bad. So as an example, just to give you some numbers, let's say that your closing costs on your transaction were $3,600 and your monthly payment savings were $200 a month. Well, it's going to take you 18 months to recoup that cost. So that's how you would determine A, will it pass the VA's requirement, which it does, because it's less than 36 months. And then B, does it fit your specific family needs and your financial goals? Will you be in that mortgage for the next 18 months? If so, and that interest rate works and that payment works for you, then it totally makes sense to move forward with that loan. Another consideration for you when you're doing your VA IRRRL transaction is the term of the loan, right? We're also accustomed to just doing a 30-year fixed loan. Well, you have the opportunity and the ability to change the term of the loan. So if you've been paying on your mortgage for a couple of years, 2-3 years, maybe 4 years, it might make sense to change the term on the refinance, maybe do a 25-year loan rather than starting over at 30. That's going to save you more interest over the long run. So definitely something that you should have a conversation about with your loan officer so you can determine if that makes sense for you or not. Now, if you shorten the term too much, like if you dropped it down to a 15-year term, that's going to most likely increase your monthly payment. Now, if interest rates have dropped enough, it may not increase the payment, which would require a pretty big drop in rates, but more than likely dropping it that much in term would probably increase the monthly payment. All right, so let's jump into what are some common questions that we get with VA IRRRL transactions. And the number one question we usually get is, can I get any cash back out of this loan? And the simple answer is no, you can't get any cash back out of it. The VA will allow a little bit. They'll allow you to get up to $500, which I know is not, life-changing dollars, but that's basically where the cutoff is at $500 is the most cash back that you can get. Because remember, we're not qualifying you for a new loan, meaning we're not looking at tax returns, we're not looking at pay stubs, we're not looking at bank statements, we're not doing all of that same amount of qualifying as you did when you bought the house. So for that reason, we can't take cash out and increase the loan amount to give you cash back. Now the VA does have a cash out program, so you absolutely can do that. It's just different. Now we have to prove that you qualify for the new loan amount. We got to do an appraisal and all the rest of it. So the VA IRRRL is just as it sounds, interest rate reduction refinance loan. That's what it is. Another common question we get is, does it need to be my primary residence? No, it does not have to be your primary residence right now. It just has to have once been your primary residence, which, as most of you know, to get a VA loan to begin with, it's only for your primary residence. So yeah, you may have bought that house 10 years ago and it's been rented out for the last 9 years. That's totally fine. You might live across the country now. You could still refinance that loan with the VA IRRRL, which is super awesome because most loan programs won't let you do that and get like primary home type interest rates. But the VA IRRRL, it lets you do it. Another question we get a lot is, will my funding fee be waived if I have a disability rating? The answer is yes. If you have a disability rating, usually it's 10%. So at any time where you're receiving money from the VA for a disability rating, which usually starts at 10% rating or higher, then the VA funding fee of 0.5% is going to be waived. The other way to get this waived is if you have a Purple Heart. So you could still be serving in active duty, so you can't claim disability yet if you're still serving, but you may have a Purple Heart, and that would also exempt you. And it should show up on your certificate of eligibility that you have a Purple Heart. But if not, we'll at least see it in your records. So we talked about the VA IRRRL benefits, the process, the common costs and the common questions about the VA IRRRL refinance loan program. Now, this is an awesome program for anybody looking to save on their monthly payment, reduce the amount of interest that they're paying on their loan, and it's a super simple and easy process. I encourage you to check on interest rates and stay current with it. You can check in with me and my team, and we will do a free analysis to let you know if it makes any sense to move down to today's current rate, or if it makes sense just to hold off and wait. We'll gladly help you with that. Now, I ask you to stay here till the end. And here's what the special offer is in the end. If you reach out to me and my team to do a VA IRRRL refinance transaction and you mention that you watched this video, we're going to provide you with a $1,000 credit towards your closing costs. So remember I mentioned those closing costs before. We're going to offer $1,000 off of those. So we're going to pay $1,000 of that for you by mentioning this video and moving forward. I'm Jason Wood, the VA Loan Guy. Please make sure to share this video, like, and subscribe for more information.